Imagine going to sleep in a relatively stable country and waking up in a nation that feels completely unrecognizable. Overnight, the price of basic food has doubled. By midday, it doubles again. By evening, it's doubled a third time. You watch the value of everything you've ever saved drain away faster than you can process what's happening. Banks reduce withdrawal limits, then close entirely. Businesses stop accepting your currency. People stand in endless lines, not for luxury goods, but for bread, milk, anything they can buy before prices rise again. It sounds like a nightmare. But this is the reality for millions of people in countries where the central bank, the institution meant to prevent disaster, has failed. When a central bank collapses, it doesn't just affect the economy, it affects every part of daily life. Today we're going to explore what really happens when the most powerful financial institution in a nation loses control, why it happens, what it causes, and why its collapse can devastate a society for generations. Introduction: what central banks are and why they matter. Every country on earth relies on a central bank, from the Federal Reserve in the United States, to the European Central Bank, to the Bank of England, to the central banks of small developing countries. These institutions are the financial backbone of modern civilization. But what does a central bank actually do? Unlike commercial banks, which handle deposits, credit cards, and everyday financial transactions, a central bank oversees the entire monetary system of a nation. It has the authority to create money. It sets interest rates. It controls lending conditions. It manages inflation. It regulates the banking system. It holds national reserves and intervenes in currency markets. And in times of crisis, it becomes the lender of last resort, the place where all other banks go when they need emergency support. Put simply, a central bank exists to prevent the financial heart of a country from failing. For that reason, many central banks are designed to be politically independent. They operate outside the control of elected officials, not because they are undemocratic, but because history has repeatedly shown that when governments control money creation directly, the temptation to print endlessly for political gain is almost impossible to resist. That resistance to political influence is meant to safeguard stability. But as we'll see, when central banks lose that independence or when their decisions are mismanaged, the consequences can be catastrophic. The critical question: what happens when the safety net fails? Central banks are built to create stability, not chaos. They are the institutions we expect to remain calm when everything else is falling apart. So the question becomes, how does such a powerful and structured institution ever fail? The answer is rarely simple. Sometimes political leaders override monetary policy. Sometimes corruption plays a role. Sometimes economic shocks, wars, sanctions, or commodity crashes destroy a central bank's ability to function. And sometimes errors in judgment accumulate until they become impossible to correct. Central bank failure isn't always sudden. Sometimes it's slow, like cracks spreading across the foundation of a seemingly solid building, quietly weakening it over time until collapse becomes inevitable. To truly understand what central bank failure looks like, we must examine history. Because history gives us examples of both sudden collapse and slow-motion breakdowns that took years to unfold. Historical case study number 1: when money became worthless. One of the most dramatic examples of central bank failure is the hyperinflation crisis of Weimar Germany in the early 1920s. It's one of the most studied financial collapses in history, but the scale of it is still difficult to comprehend. Germany emerged from World War I heavily burdened with reparations, massive debts owed to other nations. The government struggled to pay, and in desperation, it instructed its central bank, the Reichsbank, to print money. And so it did. At first, printing more money seemed helpful. But as more and more money flooded the economy, prices rose faster and faster. The currency lost value by the day, then by the hour. Imagine a world where a loaf of bread costs 250 marks on Monday, 500 marks on Tuesday, 2,000 marks on Wednesday, and 1,000,000 marks by the end of the month. This wasn't an exaggeration. It was daily reality. Workers were paid twice a day because a delay of a few hours meant their wages were worth significantly less. People carried money in wheelbarrows because it took billions, literally billions of marks to buy ordinary groceries. Children played with piles of worthless currency as if it were confetti. Families burned money for heat because it was cheaper than buying firewood. Hyperinflation isn't just an economic condition, it is a collapse of trust. Trust in money, trust in savings, trust in the future. And at the center of this collapse was the institution responsible for maintaining stability. The central bank. The Reichsbank's failure wasn't simply a monetary error. It contributed to political extremism, social unrest, and ultimately set the stage for the rise of forces that would change the world forever. This is the true power and the true danger of central bank failure. Historical case study number 2: when banks themselves stopped working. For a more contemporary example, we can look at Lebanon, a country that has experienced one of the most severe financial collapses of the 21st century. For years, Lebanon's central bank maintained an artificially high exchange rate, propping up the value of the local currency by using foreign reserves to buy dollars and stabilize the system. But beneath the surface, the economy was deteriorating. Government debt soared. Political instability deepened. Foreign investment dried up. Hard currency reserves declined. Eventually, the illusion of stability could no longer be maintained. As the central bank's reserves ran out, it became clear the promised exchange rate was impossible to defend. When people realized their money was not secure, panic spread. Banks restricted withdrawals, then they froze accounts. Then they stopped giving depositors access to their own savings entirely. People who had spent decades building financial security suddenly had nothing. This crisis resembles the Panic of 1837 in the United States, a period when collapsing land prices and credit contraction led bank after bank to fail. In both cases, the central bank or the absence of one was unable to contain the spread of panic. When central banks fail to act swiftly or lack the tools to respond, fear spreads faster than any policy response can contain. And as history shows, once public trust evaporates, the entire financial system can crumble almost overnight. What central bank failure actually looks like. Central bank failure is not always obvious at first. Sometimes it begins quietly, with subtle signs: a slight increase in inflation, a weakening currency, foreign reserves dipping lower than expected, interest rates that no longer influence borrowing behavior, banks becoming more cautious with lending. But over time the warning signs intensify. 1. Loss of control over inflation. Prices begin rising at unpredictable rates. At first people think it's temporary. Then they realize it isn't. 2. Currency devaluation. A currency losing value isn't just a number on a screen, it affects every import, every business, every household budget. 3. Bank runs. When people no longer trust the system, they withdraw their money. And when too many people withdraw at once, even healthy banks collapse. 4. Political interference. Leaders push central banks to lower rates or print money to solve short-term problems, ignoring long-term consequences. 5. Liquidity shortages. Banks run out of cash, loans dry up, businesses can't pay suppliers, the economy stops moving. 6. Collapse of trust, the most dangerous sign of all. Once people no longer believe the currency will hold value, the system is already broken. These are not isolated problems, they feed into each other, accelerating decline until the central bank can no longer perform its most essential functions. Once that line is crossed, collapse is almost impossible to avoid. What comes after failure? The unfolding crisis. When a central bank fails, the consequences ripple outward through every part of society. Businesses lose access to credit and cannot operate normally. Banks close or severely limit withdrawals. Imported goods become unaffordable. Unemployment rises. Governments lose the ability to pay debts. Families watch their savings disappear. And then, the psychological collapse begins. People rush to convert what remains of their savings into dollars, gold, or even crypto. Others turn to bartering. Some migrate in search of stability elsewhere. The collapse becomes not just economic, but social. The domino effect. When failure spreads through an entire nation. When a central bank collapses, the effects do not stay contained within the financial sector. They ripple outward, touching every part of society, reshaping the daily lives of millions. The first domino to fall is confidence. A country's currency is only as strong as the belief people have in it. You can't hold trust in your hands. You can't deposit it in a bank. Yet it is the invisible force that keeps the entire system functioning. Once trust begins to erode, everything becomes unstable. Businesses hesitate to invest. People withdraw their money. Foreign investors flee. Banks slow down lending. Prices begin to fluctuate wildly. This creates a feedback loop that accelerates decline. The central bank tries to respond, raising interest rates, selling reserves, or creating more money, but by that point, the tools that once ensured stability become weak and ineffective. A central bank can set an interest rate, it can declare a monetary policy, but it cannot force people to believe in a currency they no longer trust. And without trust, no financial system can survive. The currency spiral. When money dies, one of the most frightening consequences of central bank failure is the collapse of the national currency. A currency collapse does not happen slowly. It happens suddenly, often shockingly. People check exchange rates multiple times a day. Businesses adjust prices hourly. Families rush to spend money as soon as they receive it, knowing it will be worth less tomorrow. In countries like Venezuela, Zimbabwe, and even Hungary after World War II, inflation became so extreme that basic goods became unaffordable for most households. But beyond the economic hardship, a deeper psychological shift occurs. People stop thinking in the national currency and shift their mindset to something else, gold, or even food and fuel. The national currency stops being a medium of exchange, it stops being a store of value, it becomes a symbol of the system's failure. This is the moment when collapse becomes undeniable. A central bank that cannot maintain its currency has effectively lost its purpose. Modern examples minus when central banks face pressure. To understand how fragile central banks can be even in the modern world, we must look at recent examples. In Turkey, high inflation became a persistent problem as political pressure pushed the central bank to keep interest rates artificially low. Instead of tightening monetary policy to control rising prices, the opposite happened. Interest rates were cut repeatedly against the advice of economists and central bank officials. The result, inflation surged. The currency fell to record lows. Savings declined in real value. Living costs soared. People who once trusted their currency suddenly sought alternatives: gold, dollars, anything that wasn't losing value every month. The central bank wasn't structurally weak, it wasn't lacking tools, it was simply unable to act independently. This is one of the most common reasons central banks fail, not because they lack knowledge, but because political interference forces them to take actions that undermine stability. Venezuela's collapse is another powerful example of what happens when a central bank becomes a tool for government spending. For years, the government relied on oil revenues to support public programs and subsidies. When oil prices crashed, the government needed money it didn't have. So the central bank printed more and more and more. Hyperinflation followed. At one point, inflation exceeded 1,000,000%. The currency became almost worthless, replaced in everyday transactions by dollars and even bartering. Families carried stacks of bills just to buy a carton of eggs. Shops rewrote prices daily. Entire industries shut down. This wasn't just a failure of policy, it was a failure of the central bank to say no, a failure of independence, a failure of restraint, a failure of responsibility. The deeper reasons why central banks fail. Central banks rarely fail because of a single mistake. It is almost always a chain of events, built over years, sometimes decades. Here are the core reasons. 1. Political interference. When leaders force central banks to print money to pay debts, fund projects, or stimulate the economy for political gain, collapse becomes only a matter of time. 2. Loss of independence. If the central bank cannot make decisions free of political influence, it cannot maintain stability. 3. Mismanagement of reserves. Countries with low foreign reserves become vulnerable to currency attacks, shortages, and sudden devaluations. 4. Corruption and lack of transparency. If financial data is hidden or manipulated, markets lose trust, and trust is everything. 5. Bad monetary policy. Keeping interest rates too low for too long, delaying critical decisions, ignoring inflation, misreading the economy. Even minor mistakes can compound into crisis. 6. External shocks. War, sanctions, commodity crashes, global recessions. A strong central bank can withstand shocks. Weak or corrupt one collapses under pressure. The combination of these factors creates a slow-motion disaster that becomes visible only at the end, when it is too late to stop. The controversy. Central banks and the battle for trust. Central banks hold enormous power. They influence borrowing, spending, investment, savings, and the value of every currency transaction in a nation. Because of this, they are often the subject of conspiracy theories, criticism, and suspicion. Some claim they operate in secrecy. Others argue they are controlled by governments or wealthy elites. Some believe they manipulate markets. Others call them undemocratic. There is some truth in the concerns. Central banks are powerful. They do operate independently, and their decisions do affect millions of people. But independence is necessary. Without it, governments would print money endlessly to solve short-term problems, creating long-term disaster. At the same time, too much secrecy erodes confidence. People want to know what decisions are being made and why. Central banks must constantly walk this tightrope: enough independence to ensure stability, but enough transparency to maintain trust. And trust is the currency they cannot afford to lose. The economists view why central banks still matter despite their flaws. Central banks remain one of the most critical institutions in modern society. History shows a clear pattern. Countries with weak or compromised central banks suffer more crises. Countries with strong, independent central banks enjoy greater stability. Without a central bank, inflation spins out of control. Banking collapses spread unchecked. Credit evaporates. Currencies become unstable. Economies become vulnerable to every shock. Central banks are not perfect. They make mistakes, they face pressure, they deal with criticism, but their existence prevents far worse outcomes. A world without central banks would be a world filled with financial chaos, political instability, and constant crises. Final thought: the true cost of failure when a central bank collapses. The consequences are not just economic, they are human. People lose their savings. Families struggle to survive. Businesses close. Nations fall into poverty. Society becomes unstable. The collapse of a central bank is not the collapse of an institution. It is the collapse of trust, stability, and the financial foundation of an entire country. If you found this documentary valuable, make sure to subscribe. There are more hidden financial stories the world needs to understand. So the real question is not, what happens when central banks fail? The real question is, how many times will history allow these failures to happen before we truly learn from them? Because every central bank failure leaves a mark not just on charts or statistics, but on the lives of millions. And when the most powerful financial institution in a nation loses control, a country doesn't just face an economic crisis, it faces a transformation, one that may take years, decades, or even generations to overcome.